So good morning and welcome. Thank you for joining us today. I'm Michelle O'Reilly, the Managing Director here at Alps. And as the title of today's session suggests, 2026 is shaping up to be a significant year for brokers. We're seeing major legal changes, evolving FCA expectations, and a growing focus on compliance, data, and cultural accountability across the insurance market. For brokers, the challenge isn't just understanding what's changing, it's understanding what those changes actually mean in practice for your products, your advice, your compliance framework, and ultimately for your customers. And that's exactly what today's webinar is designed to address. We'll be breaking down what brokers can expect in 2026, where regulatory and legislative focus is heading, and where you should be concentrating your attention now to stay ahead rather than react later. We're joined today by a panel of industry experts who will bring both regulatory insight and real-world perspective. We've got Hayley Gorman from AmTrust, who will be covering the Renters' Rights Act and the upcoming Employment Rights Bill, with practical insight into how these developments impact landlord legal and rent protection policies, family legal protection on the employee side, and commercial legal protection on the employer side. We're also joined by Shenton Mike Cranny from Create Solutions, who will be taking us beyond the tick box to explore the FCA's cultural shift as we move into 2026. Including the FCA's direction of travel, the reality behind insurance simplification, the move towards data-led supervision, and the key actions firms should be taking now. The aim today is not to overwhelm you with regulation, but to give you clear, practical insight that you can take back into your business. We've got a jam-packed session, but we're hoping to have time for questions at the end. So please submit them in the Q&A section as we go. Users will be identified to us, but anonymous to other guests that have joined. And if we don't get time at the end of this session to answer all of those questions, then we will get back to you after the event. So without further ado, I'm going to hand over now to Hayley from AmTrust.
Thank you, Michelle. Good morning, everyone. My name is Hayley Gorman. I'm a legal expenses underwriter at AmTrust Specialty Limited. We're a UK insurer, and we mostly work with UK MGAs. One of those MGAs is Alps. We underwrite a range of legal expenses and ancillary products with Alps. And today I'll be focusing on some upcoming legal changes that affect some of the policies that we underwrite. I'm going to start with the Renters' Rights Act. This became law in October last year, and the major effects will come into force from the 1st of May 2026. This is a significant legislative change which introduces new rights and responsibilities for landlords, letting agents, and tenants. One of the major changes is the abolition of Section 21 evictions, or no-fault evictions. This means that from the 1st of May, landlords will only be able to issue Section 8 evictions, provided that the landlord has legally defined grounds to evict. For example, if the landlord wants to sell the property or wants to move in close family members or themselves, if the tenant has at least 3 months of rent arrears, or if the tenant has committed antisocial behaviour or breached the terms of the tenancy agreement. Another change is the end of assured short-hold tenancies, or ASTs. From the 1st of May, fixed-term tenancies will be abolished, and all new private tenancies will be on a periodic rolling basis and become assured periodic tenancies. This means that tenancies will come to an end only if a tenant leaves voluntarily by giving 2 months' notice at any point during the tenancy, or if the landlord serves a valid notice to evict the tenant under Section 8. There are also changes to rent payments. There will be a new legal process for rent increases. Rent increases will not be allowed in the first year of the tenancy, and rental increases can only take place once a year. Tenants will have the right to challenge rent increases via a first-tier tribunal at no cost, and landlords will also no longer be allowed to require rent in advance. only 1 month's rent in the period between the tenancy being signed and the tenancy starting. And once the tenancy has begun, they cannot require any payment of rent before it is due. So I'm just going to talk about the impact on landlords briefly. Currently, Section 21 evictions are the fastest route for evicting a tenant as they don't require a court hearing. Section 8 evictions do require a full court process. And from the 1st of May, the rent arrears requirement for issuing a Section 8 notice will increase from 2 months to 3 months. So the move to Section 8 evictions only will add legal costs to claims and extend the period to settlement. This may lead to extended delays at court if government plans to increase court capacities are not sufficiently implemented, which will directly affect landlords' cash flow, as each extra week before possession will increase the tenant's rent arrears. I'm just going to talk you through a quick example to illustrate how costs could increase. So under the existing legislation, eviction is triggered at 2 months of rent arrears. Based on a monthly rent of £1,200, when eviction is triggered, landlords will be out of pocket by £2,400. And the eviction routes currently available are either Section 8 or Section 21. And a likely timeline to possession of the property under Section 8 is roughly 20 to 28 weeks, which could result in potential rental income loss of up to £7,500. Whereas with Section 21, a likely timeline is around 18 weeks, resulting in a rental income loss of up to £5,000. Now, under the new legislation starting in May, the trigger for eviction will be 3 months' rent arrears. So now the landlord will have lost £3,600 in monthly rent before they can even start the eviction process. And the only route to eviction available to them will be Section 8, with a mandatory court hearing, an expected timeline of around 26 to 34 weeks, with the risk of even longer if courts do exceed their capacity. This could result in a possible loss of up to £10,000 in rental income. In the past, many landlords may have decided to self-protect while Section 21 eviction was available to them. However, the changes that will be implemented under the Renters' Rights Act may increase their exposure to over 50% of their rental income, which will make self-protection a much riskier option. There is an alternative to self-protection, and that is to take out a rent insurance policy. The landlord legal expenses and rent protection policy provided by Alps will remove financial risk, provide access to streamlined eviction at no cost, and has the added advantage of 24/7 access to an advice line to deal with any ad hoc queries. As a business, we've looked at the new legislation and we've worked heavily with Alps to make sensible adjustments to the existing policy wordings and coverage so that landlords can benefit from and continue to get great value from the landlord legal expenses and rent protection product. New policy wordings and more flexible pricing options based on banded monthly rent limits will take effect from the beginning of March, with the additional option of a new 3-month excess product. And we will also be launching a new product for letting agents, also with banded pricing and flexible excess options. And this is in direct response to increased inquiries that we've seen from letting agents over the last 6 months. Under the policy, landlords will be able to make a claim for unpaid rent arrears before the eviction process starts. And they will also have access to a 24/7 legal advice line, a tenant mediation service, and assistance with the legal process for eviction. And this expense is tax deductible for landlords. So, for example, a landlord with a monthly rental income of £1,200 can take out a standalone policy with Alps for up to £230, and this is around 1.8% of their yearly rental income, which, if the landlord is an additional rate taxpayer, will fall to around 1% with the tax allowance. This is a small payout for peace of mind, the no hassle factor, and the ability to still receive rental income via the rent protection coverage if the tenant does not pay. That's about it for the Renters' Rights Act update. Happy to answer any questions at the end if we have time. Now I'm going to talk about the Employment Rights Act. So this became law in December and introduces new reforms to UK employment law with phased implementation over the next 2 years. I'm just going to go through some of the key changes. So in December 2025, the ACAS early conciliation window, which allows the employee and employer to try and resolve a dispute without the need for a tribunal, was extended from 6 weeks to 12 weeks. So that's in force now. And then from April 2026, there are changes to statutory sick pay, including the removal of the lower earnings limit and the waiting period. The maximum period of the collective redundancy protective award will double, and there will be day one rights to paternity leave, unpaid parental leave, and bereaved partners leave, as well as strengthened whistleblowing protections relating to sexual harassment. Then in October 2026, the time limit for making a claim to an employment tribunal will change. Currently, it's 3 months for most claims, and this will change to 6 months. An extension to duties around sexual harassment reforms will come into play. The key changes are the duty on employers to take all reasonable steps to prevent harassment, and also a new obligation to prevent all forms of harassment in the workplace from third parties, so clients, customers, suppliers, contractors, etc. There will also be regulations released as to what steps count as reasonable. There will also be expanded trade union access rights granted in October 2026. And then January 2027 will see the reduction of the unfair dismissal qualifying period to 6 months. Currently it's 2 years. And the compensation cap for unfair dismissal will be removed. So first I'm going to go through the impact on employees. So this affects family legal protection policies. Earlier unfair dismissal protections and 0 hours protections means employees can expect greater job security and stability, and day one rights for paternity leave, parental leave, bereavement leave, and statutory sick pay enhancements boosts supportive workplace rights. And the duty on employers to prevent sexual harassment will lead to improved workplace culture and a safer work environment. These enhanced protections and rights mean that it will be easier for employees to bring a claim against their employer, and this means that we will see a rise in claims from employees after each stage is implemented. Taking out a family legal protection policy can enhance employees' protections further by providing access to justice. Not only will it provide insurance for advisors' costs to pursue a legal action brought before an employment tribunal, the policy also includes 24/7 access to a legal advice line staffed by qualified legal professionals to assist with any ad hoc legal and tax queries. And now for the impact the Act will have on employers. So the extension of the ACAS early conciliation period from 6 to 12 weeks will allow more time for legal advisor involvement, more time for the claimants to provide evidence and any documentation, and also increase union involvement in disputes. So while the aim of conciliation is to reduce claims, the longer window can actually increase the likelihood of an employer being taken to tribunal, especially where increased legal and union involvement can result in employees being coached through the process. Employee access to legal remedies will increase, which will make new claims easier to bring, but it will also make them harder for employees to defend. Expanded day one rights will increase the number of statutory rights available to new employees, which will create increased basis for potential claims and increase litigation against employers. And if employers fail to reasonably prevent harassment in line with the yet to be released regulations, then this too will bring increased claims from employees. Reducing the unfair dismissal qualifying period to 6 months from the current period of 2 years will increase the number of eligible claimants and make more dismissals subject to challenge, increasing the risk of litigation and adding to employment tribunal volumes. And the removal of the compensation cap in 2027 will increase employees' inclination to bring claims, increase their leverage in settlement negotiations, and will increase employers' financial exposure and lead to more unpredictable settlement outcomes. And of course, higher claims volumes lead to higher claims costs for employers. The Act will also bring increased administrative requirements to employers, as HR processes and internal company policy documentation will need to be updated in line with the Act. In particular, the new regulations on harassment protections will require formal risk assessments, in-depth staff training, updated reporting procedures, as well as updates to harassment and bullying policies. A commercial legal protection policy can help ease the burden on employers by providing access to a 24/7 legal advice line staffed by qualified legal professionals to assist with ad hoc legal queries, provide support on required administrative changes to standard documents, and provide legal advice on how to support a fair process between the employer and the employee. The policy will provide cover for defending employment disputes, and in addition to this, it will also pay out an employment tribunal award if a tribunal case that the employer has defended via the policy coverage is ultimately lost. This will assist in mitigating the potential losses that employers will be exposed to, both under the current laws and under the new regulations to be implemented in the next 2 years. So that about wraps up everything from me. And again, if there are any questions at the end, I'm happy to answer them if we have time.
Thanks, Hayley.
Thank you.
Okay, so Hayley's just gone through the two major changes in the legal landscape for 2026, and we're going to move now to create. So Karen, do you want to share your slides? Are you on mute, Karen? There we go. We can see the slides. Okay.
Hello. Right. Okay. Can you see the slides?
I can see the slides and I can hear you. All good, Karen.
Okay. Let's have a look. I'm just going to quickly stop sharing those 1 second. We'll do it in 1 moment. Okay. Is that okay? Right. Fantastic. Right. Okay. So good morning. I think we're still in the morning here. So welcome from Create Solutions. So we are a training and compliance company for the general insurance sector, dealing with the general insurance market, brokers, claims management companies, managing agents, etc. So what I'm going to do very quickly is, this is just an extract from our website. So if you want to have a look in detail about how we support firms, then please do bob onto our website. There's the email address and you'll learn a little bit more about us. So we've been operating over 20 years. So we've been around the clock, should we say, and we've seen it all. We've seen the big changes in regulation, in the insurance market, in the way things have developed and are developing, and I must say it's faster than ever. Trying to keep up with the changes. This is what we do for a living, but it's very interesting and challenging times, but also very lots and lots of opportunities as well, and exciting. So I'm going to, the title of this session we gave in relation to beyond the tick box. We are not a tick box compliance company, so we help firms with their compliance, but also developing their businesses, developing their staff as well. and most importantly, helping firms solve problems and help them get on with doing what they're good at and doing their business. So I'm going to hand you over. So I'm Karen Shenton, one of the directors, and we have Mike Cranny as well. We've worked together for a long time, Mike, 40-something years, haven't we? So, so I'm going to hand you over to Mike. Mike is going to just give a little bit of a background about what's happened in regulation, just a little bit of the background there, but also his opinion in relation to what we're seeing, the noises, and what the direction of travel is. So, Mike.
Okay. Well, good morning, and good to be able to talk to you. I've been in business an awful long time. In fact, I'm now in my 61st year of working. You can believe that. I started working in 1965. Things have changed amazingly in that time. I just really want to concentrate on the regulatory side. We're 21 years now into insurance regulation, and there is a process involved, which, if you grasp, you can understand what's going on. The process is mainly political. Regulation comes from politics. Sometimes it makes good sense, sometimes it doesn't. But we were forced into regulation in 2005 for political reasons. At that time, 2005, the man in charge was John Tyner. And we went through a period of what was known as light touch regulation. The FCA, or the old FSA, had introduced the beginnings of TCF. And the idea was that you treated customers fairly, everything would be okay. The thing is, there's always a lag between what the regulator wants and what the market's doing. Sometimes the regulator is behind what's going on. Sometimes they're in front. Light touch regulation and TCF went along quite nicely until we got the financial crash, 2007, 2008. We got new man in, Hector Sands. And he said, I want you to be afraid. I want you to be very afraid. He also said that principle-based regulation didn't work because people had no principles. So we went, from then on, we went into tough regulation. That worked from 2007 till about 2013. Not always applying to insurance, because the FSA also regulates life and pensions, and they had their hands full with some of those markets. We got to 2013, and it's a Conservative government. It was George Osborne, and a bit like is happening at the moment, he thought regulation had got too far. The head there was Martin Wheatley, and he'd said that when he came in, he was going to shoot from the hip. He was going to ask questions later. That didn't go down very well with Osborne, and they sacked him. They then brought in Andrew Bailey, 2016, and Andrew Bailey, who's now head of the Bank of England, to my mind looks like somebody's favourite uncle, Mr. Softy. He was all about vulnerable customers, and he really ditched TCF, which hadn't worked anyway. So from about 2017, 2018, there was no mention of TCF in any of their business plans. It was abandoned. People carried on doing training in it, but it was really finished. What happened then was the senior managers regime came in. Came in for brokers in 2018. It came in for banks about 2016, I think. It took, I think, 9 years to develop. So when it came in to do with the financial crisis. So it came in far too late. They then brought the insurance bit in 2 years later. So what we've got now is a regime which was designed for a completely different time. It's not really appropriate. It's been completely ineffective. There's been an awful lot of work involved and still is an awful lot of work involved. They're currently reviewing it, and I think they'll scrap the certification regime almost completely. Certainly for insurance, it was pretty much a waste of time. That takes us to the current regime, Nihal Rai, and he started, we're going to be a data-led regulator. All these terrible forms that people have got to fill in that don't make any sense, but in many cases don't go anywhere because the data collection was pretty hopeless. All that was going on fine. Let's be all technocratic when consumer duty was forced on the market. It wasn't an invention of the FCA. It came about because amendment was made to the Financial Services Act to force the FCA to consult on how to make the market responsible for its interactions with its customers. This was partly driven by Macmillan Cancer Charity and some others who had bank of evidence of claims being repudiated for travel, for you didn't tell us you went to the doctors and all sorts of things. FCA had no alternative but to bring the consumer duty in. If it doesn't work, then we're going to get something far worse, which is statutory responsibility for failure. So at the moment, they're pinning every single thing they can on consumer duty. Consumer duty really has got nothing to do with principles. It's got to do with evidence. So where we are at the moment is we're in an evidence-based regime, not a principle-based one, and not one based on fear, but on evidence. And the evidence you're going to have is that customers understand what they're buying. They understand the language you speak to them in, they understand the jargon, they understand the policies, that they get value for money and they get fair treatment. Now, that's the direction of travel, and the insurance market has been on it for a while. I don't think they've grasped completely the difficulty that's faced. We have an awful lot of interaction with the FCA. We've got 2 ex-FCA supervisors working for us as consultants. I think at the moment we've got 3 or 4 interactions going on with the FCA. They are more active now than they've been in years. So don't believe that because they're cutting a few forms away and they're going along with the government's growth agenda or trying to, that they're becoming less of a problem. They're more of a problem. And I would urge you, if you ever get any correspondence from the FCA about anything that's not routine, you take advice before you answer it, because they have a process. When they write a letter to you, every single word has a value. They don't just use words like risk or harm. They have a corporate value, and any communication of importance is checked by a committee before it goes out. So if you get an email from the FCA, be very, very careful, because you embark upon a process which can end in supervision, and then if you can't satisfy supervision, which usually takes months, you end up in enforcement, and that takes years. And really, you don't have to do anything wrong to go down that path. You've just got to stick your head above the parapet, or have an advert on your website that's not correct, or have a disgruntled employee or a whistleblower. So the direction of travel is quite difficult. It's a bit like in insurance, you have hard market and soft market. We're going through an apparently soft touch, but very hard based. So everything's hangs on consumer duty and the evidence you've got. And it's not about policies, it's about what evidence you've got of achieving the outcomes of fair value. Okay, I think that's all I need to say on that.
Thank you, Mike. Thanks. That leads me into my next slide. And you've just done some of my job for me, because you touched on
Can we
consumer.
go home early?
You can go home early. So that's excellent. Yes. So Mike, like Mike said, consumer duty it's been around now for a few years. Most firms on here would have been through the process of producing their board reports and attesting that they're meeting and delivering good outcomes to their customers. Just as a reminder, it's what the FCA are looking for, and we've heard noise that there will be looking into these particular areas this year, and possibly putting out surveys to the market to ensure what firms are doing on checking customer understanding, on the products and services outcome. How are they getting on with their outcomes monitoring? How effective is it? So it's important that you are able to evidence this. I've put this in the bottom here, customer journey review. Just as a reminder, and I'm sure you are as part of your consumer duty work, but just to ensure that if you're making any changes to any products, if you are bringing on any new products, to ensure that you have the full journey around that, that you've got your fair value assessment, that you've done your customer journey for that product, that you've got your training, and that how do you know that you're delivering good outcomes for that particular product. So it's quite easy for, as you're a busy firm and you're taking on new products and procedures, etc., to forget. It's not just a once and done job doing the board report. It's an ongoing requirement. So some of these slides that we're doing today that I've put in, because we can't cover everything in 30 minutes. So these are just kind of like high level recommendations and observations. So if you do want any more information on any of these topics that we're going to cover today, please do contact us, and we're happy to discuss further. So I'm just going to move quickly on to this next topic of premium finance. And there's been a lot of noise in the market over the past year, and the FCA have recently issued their market study. It's only just come out, and if you want to go and have a look at it, which I do recommend, is worth a read, MS24/2. So in essence, this is good news for the market. This is good news, but there are some actions that firms need to take as a result of the paper. So for the work that the FCA have been doing on premium finance, they worked with 10 firms. I believe they reviewed 10 firms where they were outliers in relation to like the APRs and interest rates that are charged, but really challenged four of these firms that we understand. As a result of the work that's been done, there has been quite a large savings for customers in relation to the APRs. They've dropped by 4.1% since 22, and have saved customers £157 million. So that's from their intervention in relation to proving good value on these products. The good news, the FCA are not implementing any price caps at all, and there aren't going to be any new rules on premium finance. They are going to rely on the overarching piece of regulation that Mike's just talked about is the consumer duty. Everything comes under the consumer duty umbrella. So what we recommend that firms do, go back to, or if you haven't done recently, go back to your fair value assessments on your premium finance offering. It is a product that you're providing. Check it against these market study as well. There's lots of good practice in there and poor practice. So we recommend that you do that. The FCA will be continuing to monitor premium finance. They're keeping their eye on it. So they will monitor the APRs that are charged in the market, and they will be using the regulatory returns to keep an eye on what's happening. And if they find bad practice, then they will intervene in the market. So just to bring you some good news, in effect, on premium finance. So that's some good news, but we do have to show that we take some action. The next topic I'm going to just very quickly touch on, which the FCA have indicated that is on their agenda, is outsourcing. So many firms that we deal with, they find that outsourcing is essential to their business. It brings efficiencies to what they do, cost savings, and also better outcomes for customers as a result. And it's a core part of their business. However, there are some pitfalls, and if not done properly, then can lead to serious consequences. So some of the areas to be concerned about, we have done a webinar on this particular topic by an expert from Gibraltar, is not having the evidence to prove that you've got good MI, and reporting procedures. The due diligence that you've conducted on that partner is sufficient, and he's telling you what you need to know. Ongoing oversight, that's important. Weak agreements with the outsourced companies as well, and also firms not considering doing any testing when it comes to the exit plan. So managing incidents and reporting as well. So if there's an incident at the outsourced firm, what's the reporting procedure? So what the exit, going back to exit testing, when we held our webinar, Monica Suki talked about this, and that it's as part of your BC, your business continuation planning as well. It's a good idea to incorporate some of this. She referred to when firms fall out, or there's been a serious breach, etc. Then it can be very painful, very, very painful indeed. So we need to make sure that you've got your procedures in place for customer communication, for finding another transition into a new provider, and also the data retrieval. So there's a lot. So key thing here is that you can outsource, but the accountability still remains with the principal firm, and evidencing everything that you have in place is very, very important. So that's outsourcing. Mike, I'm just going to quickly move on to simplifying insurance, and are you going to touch on the training and competency side of things?
Okay, simplifying insurance, the FCA had a go at trying to simplify things. The rule book's so complicated, it was difficult. They have made really two changes of note. One is they've disapplied the PROD rules, the ICOB rules, effectively, and the consumer duty to large firms. And large firms are those that can bring a complaint to the Ombudsman. So they've aligned the DISP procedures with consumer duty. So consumer duty applies to all individuals, micro enterprises and small firms, but it doesn't apply to the large firms with more than 50 staff. Should you make any changes? Probably not. You better treating everybody in the same manner rather than trying to separate them out and making a mistake. The other is, and this is all driven by trying to please Rachel Reeves and show that they're cutting regulation to get Britain moving, which doesn't look as it's going to happen. Is they've taken the mandatory 15 hours of obscure subjects that you were supposed to study for the IDD. They've taken the 15 hours away. They've taken the sort of safety net away. They've taken the tick box away. It's replaced by the rule that was always there, that your staff have got to be competent for the work they do, and in particular the training they get must be relevant to the job role. So does it make any difference? No. Should you change what you do? Yes, I think so. It'd be nice if people got training in connection with the job role. I can tell you an awful lot of call centres, you won't find a single person that's ever read a policy in their entire business life, and yet they sell them. So that's simplifying insurance. A few minor things on lead manufacturers, on removing some redundant rules, but really nothing you have to do. So that's good news.
Yeah.
I think we probably need to speed up a bit, Karen.
Yeah. Okay, right. Okay, so let's move on to very quickly product governance. And Mike has just mentioned very briefly as part of the simplifying insurance that there is a change to the definition of the definition of contracts of large risks, and this has changed to a definition called larger commercial customers, but there is also another area called specialist risks as well. So in relation to co-manufacturing and responsibilities, there are changes here. The co-manufacturing, the rules that now are optional. So what we recommend that firms do is they obviously speak with the lead manufacturer and ensure that they are clear on what the responsibilities are. There is also a relaxation on doing the annual assessments, product reviews as well, but we advise that the fair value assessments, it's good practice to review your product governance and your fair value assessments on at least an annual basis, or if there are any changes before that. So changes in the product governance, co-manufacturing world and definitions in relation to the larger commercial customers. So in relation to data and tech, my FCA shift, we've talked about the endless returns that the firms have to do and the amount of resource and time that it takes. They are becoming wanting to make things a lot smoother for firms, and they are working hard on this, and we have seen some evidence of some good work, and it really is improving. So some more good news in this front, in that the FCA have introduced, well, there are certain systems at the moment for reporting to the FCA. There's Reg Data, there's Connect, and then there's the online invoice portal system. Those are all being combined. Those three systems are being combined into My FCA. Some of you on here, that was introduced in November. So some of you who are on here today may have already been on to My FCA. So there's one login, and you can switch between the portals on this one login. So when the home screen comes up on My FCA, when you're doing your reports, there'll be a snapshot of what reports are due by your firm. So their aim is to streamline things, make it less resource heavy for firms, have richer data so they actually know what's going on in the market as well, and remove any unnecessary reporting. There have been some reports that have been removed. There's the Rep 21 and the Rep 22 are being removed. And there are also some reports that are currently done quarterly, which have now been moved to annually as well. So this will save some time for firms as well and make it a lot easier. There are also plans to reduce the fees for late reporting from £250 to £100. However, that may sound like good news, but it's not really good news at all. What this does is that there's indicators that go off on your, I would say if they had a governance file at the FCA on your firm, there'll be, highlighted how many times you've missed the returns, what's going on at this firm. So it could spark some interest. So don't leave your report, as a reminder, don't leave your reporting till the last minute. Don't rely on reminders from the FCA as well. Those are not always guaranteed that are coming through. We've had some firms who said, well, we didn't get a reminder. Don't rely on reminders. Log in once a month. I'd recommend you log in once a month and you make sure that the right people are registered on the system for receiving the information. So that's a little bit about the return side of things. Just very quickly moving on to these. There's a new consumer credit return due out, and that the first one will be due 40 days after the 1st of January. So you will need information for that. So that will affect firms who've got credit permissions or arrange premium finance. There are also changes to the returns in relation to reporting on your PI insurance and the training and competency returns, which are currently every 6 months. Those will be going to an annual basis as well. In relation to some more relaxations, the Rep 008 has been removed. The 22 in relation to pricing attestations been scrapped, and the Rep 21 for closed books is being removed. Just very quickly, we've mentioned on the PII and T&C now annual the reports. Check your schedules, make sure you don't miss any. Quick changes to note in relation to travel insurance. Here, the signposting rules came into force for travel insurance back in 2020, and where firms who provide this particular product, travel insurance, have to provide signposting to a medical cover firm directory if some medical conditions are excluded from what they can offer, or the premium has been increased by £100. That has now been increased to £200. So just make sure you've got your scripts updated, or your policies, your procedures, your websites reflect that, because the signposting needs to be on your websites as well. So just a reminder there. Mike, this is quite timely and links in with a lot that Hayley covered this morning as well when she talked about bullying and harassment. So that was quite interesting. Do you want to just talk about this quickly?
What about direction of travel? 2007, 2008 was the financial crisis. It took nearly 9 years to bring the SMCR in. This is the last bit of the SMCR. It's coming in at a time when everybody's trying to row back unnecessary stuff. So it's completely inappropriate to bring in the rules that they applied to banks, or tried to apply to the bank after the financial crisis. It's the biggest change in culture for many, many years. This year's BEBA will be the last BEBA conference that you can misbehave at without getting caught by the non-financial misconduct rules, because they will apply to business events. Yes, the FCA's purpose is it only applies to very serious cases of things like bullying and intimidation and violence, but there's all sorts of grey areas. We have a procedure for this. These rules come in September. You've got till September to get hold of them. You need two aspects to this. One is HR. I have to respectfully tell them to keep out of it until you've fully understood it. And the other is you've got to understand the regulatory side. There is a disconnect between the regulations and HR. The regulator is trying to prevent people working in insurance who are not fit to be there because they bully and harass people inside or outside the office. Quite a lot of this can be subjective, where somebody claims somebody's looking at them funny, or tracking their movements, and so on. So all staff, it's going to apply to all staff that the current COCON rules apply to. So it doesn't apply to cleaners and so on, but it applies to anybody that's working on the business side of your business. They're all going to have training, and they all need to realise that certain activities, like the office party, get caught by this. So we'll be putting a series of webinars on and training sessions, and this will be the big change, I think, for the market. A big cultural change, and to my view, really should have happened years and years and years ago, and doesn't really fit in with the current direction of travel.
Yeah, thanks, Mike. That's a really good summary. And as you say, it's a big change. Every firm, every regulated firm has a person who is responsible for the code of conduct as one of their responsibilities. So it's very, very important that that person and the board and the senior management understand what this is all about and what the consequences are and what they need to do. So I would recommend that you start to, if you haven't already, start to raise this in your board meetings at board level, engage with HR, because it has to be a collaboration of HR and compliance and risk. There'll be changes required to staff handbooks. There'll be training for all staff at all levels as well. So that's that. But just very quickly as well, we are.
Can I just say also, it will probably mean that you can't use NDA agreements to let people leave.
Yeah.
What you might be able to do on HR, you can't do in regulation.
Right. Okay. On the 17th of March, we're holding a bite-sized session, an hour, just on this topic. It's going to be an awareness level for people who are senior or who will be involved in the rolling out of this, any changes. If you're not a client of ours, of Create Solutions, we would normally charge for this. I think it's £89, this particular one. But for today, if you want to go on our website and book and enter in the code, I'll put it further down, but Alps Feb 26 in the code, Alps Feb 26, then you can come on this session free of charge. And that will be a really good start to evidencing that you're taking reasonable steps and you're taking this seriously. So please do take advantage of that. Just going to move on very quickly now to, I know we've covered consumer duty, but complaints. This is, there's major changes afoot on the complaint side of things. So in relation to complaints, there is going to be, they are simplifying the complaints process here, simplifying this area. There are currently 5 different types of complaint reports that come in from the various firms, whether it's claims management companies, consumer credit companies, the insurance market, etc. So they're going to combine all these into one return. So there will be a new report, a new complaint return. It sounds a long way off, but firms need to start looking at this now, because you're going to need to collect different types of data. So there's going to be a new complaint return in 2027. The senior management and risk and compliance all need to be involved in preparing for this. The first report will be due July 27. But the data will be required for the first half of 27, so from the 1st of Jan to the 30th of June. There's going to be new categories of complaint reporting, so it'll be more meaningful. How you record complaints will change internally, so you'll need to make changes there. And they will also be adding extra information required in relation to vulnerable customers as well. So, so there's some major changes there. You may need to speak to your software houses as well. I'm sure they will have this in their sites, but to help you in the collection of the MI and data. In relation to just quickly relating to complaints, the FOS, there's major changes there as well. Some rule changes will be afoot in relation to complaints handling. The FOS, the FCA and the Treasury are collaborating on this. So they're looking at how complaints are handled. So there's going to be changes on how complaints are handled, the time limits, how redress schemes are mass redress schemes are implemented, acknowledgement letters may change. So there's going to be a lot to do in this particular area. So this is just to highlight that this is another area for your small to-do lists. So that's that. And then in relation to consumer duty, I know we've covered it in other areas, but they seem to be very keen on looking at sludge practices in firms. You know, how easy is it for firms to speak to a human being going around in doom loops, chat bots, sludge practices, not easy to cancel policies, not easy to make a change, not easy to make a complaint. So this is all part of their ongoing work. It all comes under the consumer duty. So so that's that. So Mike, are you finishing up on this, what this means for you?
First and last thing I'd say is try and understand the direction the FCA is going in. Consumer duty is about evidence. It's not about having policies and procedures. It's about evidence. Evidence that customers can understand what they're buying, that they're getting fair value, that they get a decent level of service. They're an unpredictable lot, the FCA. Predictable in some ways. A muddle of departments, some very, very nice and some not so nice. It's a look of the draw who you get. They work very, very hard to cooperate. They're very friendly now. Talk to compliance officers, speak at events, and so on. But the process behind it is they want quite significant improvements, and even though things appear to be simplifying, don't believe it. Keep on your guard. And the best advice I give to anybody is keep out of the radar. Keep off the radar. Do the things you're supposed to do. Do them on time, and keep away from it. I think we've just about run out of time now, Karen.
Yeah. Okay. So vulnerabilities under the microscope remains under the microscope. So so these are just some things for you to just flipping back.
If I leave those, Karen, is just privacy notices. Privacy notices don't need updating, but they will do. There's just one other minor change coming in. It's not coming in from FCA, it's coming in from Information Commissioner. Sometime this year, people will get the right to complain to the data processor. At the moment, you can only complain to the Ombudsman, which means you will have to have a complaints procedure. And how that'll fit in with the DISP complaint procedure, I don't know.
Yeah.
The act is already going through Parliament, but we don't know when it will come in.
Okay, excellent. So if you want to have a look at our website, like I mentioned before, you may already have compliance support, but with an external firm. But please do check us out if you want to. If you want to have a free 30-minute consultation with us for help and assistance in any of those areas that we mentioned today or anything else, within reason, please do contact us. So there we are. Here's please do register for the course I mentioned earlier, the non-financial misconduct. It'll be free for people who attend today. But just to let you know, we do a compliance academy for anyone with a compliance role. We do lots and lots in the vulnerability space as well, all very reasonably priced. We always have something of a technical nature on our cards. So the next one coming up is on avoiding the underinsurance trap. For those who are new to insurance, never had any insurance training, or just want a refresher, there's our All You Need to Know About Insurance course, which has been going 20 plus years now. And there we are, there's the bite-sized session that you can go on. So yeah, please do check us out, and want to speak to us, please do so. And if you have any questions, then we'll hand back to you, Michelle, and you can direct. Thank you.
Thanks, Karen, and thank you, Mike. So I think the key takeaway then is that 2026 is less about the prescriptive rules, but it's about evidence, culture, and obviously brokers that get ahead of the curve are going to be best placed now. So we've heard today from Hayley, who's talked about the scale of the legal changes, and in particular with the Renters' Rights Act and the Employment Rights Bill. In response to that, we've, in the evolving legal landscape, Alps policies have already undergone and will continue to undergo changes to ensure they remain relevant, compliant, and genuinely supportive of customers. So if you're an Alps broker, we're going to be continuing to support you throughout 2026 and beyond. Many of you will already be familiar with our Broker Hub on Communicate, which provides you with access to policy documents, IPID, fair value or target market statements. And we'll be making further enhancements to our Communicate portal to make sure that we're better supporting our brokers with compliant decisions at the point of inception. So there are new monthly MI packs that have been introduced, and that contains a lot of policy sales and claims data for our broker partners, so that you can that will help you comply with your consumer duty obligations and improve visibility. And that will be continuing to evolve. At the moment, we can only see motor legal claims that are serviced in-house by Alps, but that will continually be evolved across 2026. So all of that is designed to help you remain compliant and feel confident that you're meeting your obligations. I'm really grateful again for Hayley, Mike and Karen joining us today. And thank you, Karen, for the offer of the webinar as well. If anyone wants the details of that, we can send that out to you. So that's the non-financial misconduct bite-sized webinar, and also I believe you're offering a free 30-minute business review as well for anybody that that feels that they might need a little bit extra support. So thank you everybody for joining today, and we'll let you know about the next webinars that are coming up over the course of 2026. Thank you very much.
Thank you.
Thank you.
Bye everyone. Bye.
Bye.